Hello, everyone, and welcome to this webinar on climate resilience, which forms part of Insurance Europe's Resilience Week of events. Before we begin, I'd like to take a moment just to thank Mazars for sponsoring Resilience Week, and we're very grateful for your support. My name is Don Forgeron. I'm the president of the Global Federation of Insurance Associations, and also president and CEO of Insurance Bureau of Canada. Canada is slowly emerging from the grips of the pandemic, and I hope wherever you are, the same holds true. I'm the moderator for today's session, and it's my pleasure to introduce Jad Aris, Managing Director of the Geneva Association, to introduce the session. Jad, the floor is yours.
Thank you, Don, for your kind introduction, and thank you to Insurance Europe for the invitation. It is a pleasure and an honor for me to introduce today's debate on climate resilience between two such distinguished speakers as Christian Mumenthaler and Sven Giegold. With the climate crisis, it is the first time in history that humanity is facing an existential threat. The purpose of insurance is precisely to protect people, businesses, and communities against risks such as the ones caused by climate change. There is now ample evidence that there has been, in the past few decades, an increase in frequency and in severity of natural catastrophes worldwide, and that this increase is linked to global warming. The insurance industry has been playing its role fully in supporting those affected by these natural events, but over the past 6 years, its role has been going far beyond. And if I pick 6 years, it's because I believe that the 2015 Paris Agreement has been a turning point. I would like to highlight 5 major transformations of the insurance industry's engagement with regard to climate change, and hopefully that will set the stage for the discussion between Christian Mumenthaler and Sven Giegold. 5 transformations. 1, from adaptation to mitigation. 2, from mobilizing investments to mobilizing underwriting. 3, from penalization to incentivization. 4, from corporate social responsibility to a core business issue. And 5, from individual action to collective action. Let me elaborate briefly on each one of those 5 transformations. The initial engagement of the industry has been, of course, to adapt to the consequences of climate change and to protect vulnerable people, businesses, and communities against its adverse consequences by providing adequate coverage. The insurance industry has also encouraged and supported governments, most notably in emerging countries, to move from post-disaster response mode to pre-disaster risk management, planning, and financing. Its contribution to initiatives such as the African Risk Capacity or the Caribbean Catastrophe Risk Insurance Facility has been instrumental. But the insurance industry has come to realize that it can also help mitigate climate change and support the world in reaching the Paris Agreement 1.5-degree objective. For example, since the middle of the previous decade, an increasing number of insurers have initiated massive divestment programs from the most carbon-intensive industries such as coal mining and coal power plants. These programs have covered both equity and debt investments, and the criteria to implement these programs have become over time more stringent, with divested companies' share of revenues coming from coal being lowered over time. This was the first transformation, the industry moving its engagement from adaptation to mitigation. The second transformation is that in their mitigation efforts, insurers who initially mobilized their assets have also started mobilizing their insurance underwriting, introducing limitations to the underwriting of the most carbon-intensive industries. The difficulties of such an approach should not be underestimated. contrary to investment decisions, which are in the hands of a small number of staff members, of people within an insurance company, underwriting decisions are in the hands of all staff members who hold the underwriting pen. So the educational efforts and cultural change programs that accompany these policies should not be underestimated. Beyond employees, such policy changes have to be explained to a wide range of stakeholders outside the company. Of course, corporate customers themselves, brokers, shareholders as well. The case for divestments can be explained to shareholders with the rationale of avoiding to find oneself with stranded assets on the balance sheet. The case for letting go what is sometimes profitable business can be more challenging to make. It can even open the door to litigation from some shareholders. The examples that I have shared so far in the insurance industry's contribution to mitigating climate change were examples of penalization of carbon incentive industries. But the role of insurers is not only that of a stick. Both on the investment and on the underwriting sides, insurers engage in a fruitful dialogue with their investee companies and with their corporate customers to support their energy transition into low-carbon economic models, and to find ways to incentivize the transition, either by financing green projects, for example, issuing green bonds, or by developing innovative insurance solutions to support green projects, renewable energy from residential solar systems, wind farms, green buildings. This was the third transformation, moving from penalization to incentivization. All these changes have led insurers to review their governance around climate. A survey conducted among Geneva Association members in 2017 shows that back then, for more than 50% of insurers, climate was essentially a CSR topic, corporate social responsibility topic, not necessarily linked to core business, and typically addressed by a dedicated CSR or sustainability team with limited leverage on investments or underwriting teams. Since then, the momentum towards making climate a core strategic issue for insurers has been clearly accelerating. Climate change is now in many insurers a board level and executive committee level topic with short, medium, and long-term implications impacting business strategy, operations on both sides of the balance sheet, and enterprise risk management. The fifth transformation I would like to highlight is the move from individual action to collective action. Individual action is useful, but it is not sufficient. For example, the effectiveness of one insurer declining to finance or to underwrite a new coal project is limited if alternative financing or insurance capacity can easily be found. Hence the need for collective action. Two recent initiatives manifest this transformation: the Net Zero Asset Owner Alliance, which indeed covers all types of asset managers, but insurers are, of course, a very important part of that, and that initiative is being led by Allianz. And the more recent Net Zero Underwriting Alliance under the sponsorship of another insurer, AXA. The final trend I would like to highlight beyond the five transformations I've referred to is the growing importance of environmental topics beyond climate in the public debate and on the agenda of insurers. Let's take biodiversity erosion. It is both a cause of climate change and a consequence of climate change. A cause: massive deforestations decrease the Earth's capacity to absorb CO2, thus contributing to global warming. And a consequence: the increase in sea temperatures, for example, is leading to the disappearance of 30 to 40% of marine animal species, with major consequences on the world population's access to food. Insurers are increasingly tackling the topic of biodiversity erosion as well. Let me stop here. I hope to have somewhat set the stage for the upcoming discussion. I also hope to have illustrated the extent to which, on climate and environment, the insurance industry can be a force for good and contribute to a better world. Thank you for your attention. Don, back to you.
Thank you, Jed, for so wonderfully setting the context for our session. I know it will spawn some comments and some questions from the audience, and I encourage those in the audience to please submit your questions, and I will look to raise those a little bit later in our session. As Jed mentioned, we have two panelists with us today. Sven Giegold is a member of the European Parliament, and Christian Mumenthaler is the Group CEO for Swiss Re. So good afternoon, gentlemen, and welcome. I'm pleased to moderate this session, and I would like to get us started right away. We'll go right into questions. And Christian, I would like to start with you first, if I could. Swiss Re and you personally have been very clear in your public statements that you believe climate change poses the greatest long-term risk to the global economy. And Swiss Re is committed to achieving net zero emissions for your operations by 2030 and your entire reinsurance business by 2050. Can you tell us why?
Yeah, Don, I think it's probably in the nature of our business model. So Swiss Re has a lot of scientists who are here to try to model different risks that exist across the world. They're also always at the lookout. And in 1979, they mentioned climate change for the first time in a publication. And then they looked further. And in 93, we had a publication around climate change as a serious threat. But at the time, and even 10 years later, when I was engaged in the topic, there was a little interest in the business community, I have to say, around that risk. There were some people knowing it, but it was still not very popular. So in 2003, we decided to get carbon neutral, as it was called at the time. It's not the same as net zero. You buy certificates, and then we tried our own operation to reduce the carbon footprint, which we did about 60% per employee since 2003. And then we started to tackle scope 2 and 3 of the value chain. So we've been there early on. There were other companies, but it was a small minority. And for 15 years, I've been engaged on that. There was not a lot of movement. And this has changed quite radically the last 3 years, I would say, for different reasons. Maybe we get into that. But you asked me why. So the net zero, that's a target that the scientists have set, and it's a translation of the Paris Accord, basically. So Paris said maximum temperature increase, and scientists have tried to say, what does it mean in terms of carbon emission? They came to this 2050 net zero, which is extremely difficult to achieve. But we think it's achievable, but extremely difficult to achieve. And it's a combination of decarbonization and carbon capture. And then for another 50 years, which is not mentioned very often, a net carbon capture from the atmosphere. So when this came out, it was a natural for us to join the movement. I think it's a difficult movement, but everybody has to go in together. The countries have made different commitments to that, and more companies are making the commitments to that. And together, I think there's now enough momentum for a tipping point to actually get there. Our own operation, we set a different targets. 2030 is much easier. It's in our hands. So we said by 2030, we're confident we can be net zero. And also that will be a combination of further decreases in our own footprint and emerging carbon capture technologies.
Thank you, Christian, for that. Sven, if I could turn to you and ask, how important is the broader financial sector, the role it plays in the world's ability to transition to a sustainable economy?
Well,
and I guess secondarily, sorry, I'll just add on to that, Sven, if I could. And what are the key, as you see it, the regulatory gaps that exist now that would help us pull that transition forward?
Well, look, first I would like to say that I was very pleased to accept that invitation because I recognize the role of insurances globally in order of the larger businesses to be clear drivers of that topic. Obviously, you pointed to this in the introduction, that you are also affected strongly, but this makes you a natural ally when it comes to fighting climate change. And of course, the role of the financial sector has to be answered on two levels. So there's the obvious one, and that is, of course, that in the risk modeling, in the right form of dealing with assets and underwritings, you have a key role to play. And of course, the financial sector is all about managing risk, and therefore it is so important that this risk is measured correctly, that there's no wrong short-termism, which we have seen a lot in overlooking longer-term risks, where the financial sector and financial markets, by their nature, have a tendency to not factor in long-term risks early enough, but rather in a disruptive manner. And this is contrary to what we want, and therefore policymakers and also actors in the sector can help to make sure that these risks are actually correctly priced. The second one is perhaps even more important, and I say that so bluntly, because we see a lot of resistance from the respective industries which need to transform, because it means phasing out old business models earlier than it would be done by the market. Therefore, they cause a lot of resistance to policy measures. So earlier CO2 pricing, sectorial rules and regulation, change of consumption patterns. And if we see the long-term, low interest rates at the long end, and the need for higher investment in order to transform business models earlier, there's a natural alliance between the interests of banks and insurances of pushing upwards the investments of the so-called real economy, increasing long-term interest rates. But for this, we have to win the policy debates. And there we need financial actors to make the arguments in order to counter the polluters' interests in the policy debates. So what I would like to see more is a stronger, even stronger alliance, and I'm very welcoming that you have done this often in the past, but the louder the better, to say there is also a business case for earlier investments into the future business models, rather than only a business case for lobbying against higher ambition. And that is where I see a natural alliance between financial industry on the one hand and greenish policymakers on the other hand, whatever party color behind it.
Thank you, Sven. And I should say both to you and Christian, if you want to intervene and add to this and turn it maybe more into a discussion, I certainly would welcome that. So I will pause after each to see if there is any comments back. But thank you, Sven, for that. You've touched on a number of topics that I know are proving challenging. I'm speaking to you, as I mentioned earlier, from Canada, a large energy producer, and I can tell you the debate is very much alive here about trying to find that balance and working towards that transition. And we've seen the impact in Canada of some of the decisions that have been taken by the industry and by policymakers that in some cases help with the transition, and in other cases make the transition more difficult. But the transition is something I think that warrants some discussion, and perhaps we'll come back to that in a moment. Christian, I'd just like to turn back to you for a moment and talk about something that we in the industry talk a lot about. We met with members of the Global Federation of Insurance Associations, met last week with G20 leaders in Italy, and we talked about the protection gap that exists. The fear that a bad problem much worse. Where are the biggest insurance protection gaps being created by the change in climate? And to drill down even a little bit further, are there particular parts of the world or sectors or lines of insurance that are especially impacted by this?
Yeah, it's a difficult question. If you allow me, maybe I just react to one. I agree everything that Sven mentioned. I would just say that we always put together with banks, and I think insurers and banks have a slightly different business model. And the particularity of insurance is that we take very long-term liabilities. So I think, so for example, we paid last year claims from contracts that were written 40 years ago. And so 40 years later, people count on us paying the claim. So there is probably a bit stronger, let's say, affinity to this particular problem by insurers than maybe the banks. But that's just a small item. So protection gap is defined, I think, for our audience as the difference between what's the economic loss of natural catastrophes and how much was insured. And overall in the world, the gap is, I mean, the portion of the economic loss that is not insured is much bigger than the one that is insured. And it makes a big difference for resilience because if a country is hit and insurance flows within weeks and months and everything can be rebuilt, it's a totally different path than if everything is destroyed and they have to wait for the government to come and 10 years later things are not yet rebuilt. We can see that in multiple occasions. So the protection gap is large. It depends on the situation. So in Europe, it's actually one of the smaller ones. So 43% in the EU is protected. But also there are big differences between certain countries. You might remember Italy, where you had earthquakes, only 1% to 2% of the population is insured against earthquakes. So everything is destroyed and is not being rebuilt 10, 20 years later, unfortunately. So these protection gaps are significant all across the world. There are different reasons why they exist. In some countries, people are too poor to pay insurance or there's no insurance. In the developed countries, it has a lot to do with psychology. So people not trusting insurance or don't want to pay for something they haven't seen happen for the last 10 years. Now, the difficult question you ask is how is this going to evolve with climate change? And that's very hard to predict. I mean, typically it's going to be in the property sides, on the natural catastrophes. The science is not yet completely conclusive on hurricanes, whether we have seen a big shift. But it is conclusive on what we call these secondary perils. So drought, floods, fires. There's a clear scientific evidence now that these are increasing quite significantly. And so the costs are increasing. You see that in the agriculture, also agriculture insurance is more touched by that. And so I think a lot of the poorer countries will be touched even more proportionally than some of the rich countries. We tried to make a study, and that's very difficult, that to be clear. But what will be the economic loss overall, the output loss by 2050 if we stay on the current path? And it's about 14% GDP impact. That's what our experts say. And they look at it in very detail. So what sector is every country involved in and how will every sector be impacted by climate change? So rising sea level or agriculture, tourism. So it depends very much what you're dependent on. And in that study, and that seems very plausible to me, Southeast Asia is one of the most touched region. And generally the southern regions are more touched by nearly everything. The economies depend more on agriculture. The economies depend more on tourism, which might suffer from that. There's less in the tertiary sector where people work from offices. Countries like Norway or Germany or Switzerland are less touched by all of these factors. This is only, obviously models, and but they are quite plausible. So the gap will increase most likely, and it will increase most where there's already not that much protection. That would be a simplified view at this stage from myself.
Thank you, Christian. We're seeing the impact of climate change in Canada as well, where flood insurance increasingly is becoming more difficult to purchase in parts of the country that had previously not really experienced a frequency of flooding, but they do now. Sven, before I turn to another topic, anything you'd like to add from your role as an elected official? Is this something that you're running across in terms of people unable to purchase cover or simply deciding, as Christian said, making the economic decision not to purchase cover?
Well, I can only, first of all, take up again the ball of Christian. Of course, I didn't want to confuse you with the bank. And I know that insurances, by definition, are totally different and have nothing to do with banks. However, leaving jokes aside, there are big differences in the business model. But the question was about sustainable finance. And both are, of course, strongly affected. And when it comes to the long-term interest rates, I know a lot of insurances complaining about this. I know a lot of banks complaining about this. And at the same time, I note a certain silence when it comes to the polluters lobby stopping policymakers or making more difficult for policymakers to take decisions which would help to push up the long-term interest rate by higher investment needs. And there I only encourage, I've seen and I agree that clearly insurances were the first movers in sustainable finance. You started with this debate when the banks were still silent. But now I would say you could become even more louder, in particular when your colleagues in the bigger business federations of the so-called industries are putting the brakes into policymakers' actions. We need you to be loud. That's all what I wanted to say in my usual direct way. And there you are in a similar role as banks. However, when it comes to not properly covered risks, I would say, yes, that is, and you pointed to the figures, which are pretty depressing if you look at the respective figures and the different coverage ratios. Even Switzerland and Germany only have a coverage ratio of about 50% when it comes to the somehow climate and the like natural disasters related risks. So there's still a lot to do. And insurance provides a form of solidarity in covering these risks. So as a policymaker, I think we have a strong interest in an adaptation effort to tackle these issues. And therefore, what you are doing in Canada is highly interesting, because actually it was often a hot potato for policymakers, because in sensitive areas, insurance becomes more and more expensive and less available. On the other hand, the decision to allow settlements and investments in areas which are difficult now were collective decisions. So there has to be a sort of burden sharing. You cannot leave these people with the risk alone. And when the risk materializes, you need a big investment program, and you say by the state and say, inshallah, then you have the public effort, the public support for such a big loss coverage. It could be more efficient to agree on an insurance-based model ex ante. It could also be less expensive for the state, but for this, the state has to be active in order to close these investment gaps. And therefore, I'm very interested in forms where the state, rather than every 10 years or every 5 years having to put out a huge relief program, to have a more systematic approach. I think it could be cheaper for the state, it could be additional business for you, and it could have more people who get their stuff covered. But all this also means that we need collective efforts to reduce the respective risks. So, for instance, in the river areas, it makes no sense to allow more and more risky investment, which we then bail out every few years. So that makes no sense either. So it's a collective public policy approach where I think there could be a typical case for good cooperation.
Thank you, Sven. I think you very eloquently said what Christian and I would wholeheartedly support, which is policymakers and the private sector need to work together. That's the message we have been taking to governments around the world. I was tempted to say, if you wanted to run for Prime Minister of Canada, I may sign up to manage your campaign if you take that view to Canada.
Well, look, the time that many Germans moved to Northern America is luckily over. And that was not, in all human rights relations, the best history. However, that was a good joke. And I'm not sure whether your colleagues in the tar sand industry would appreciate a green from Germany so much. So, but that is interesting how you insure these people. So that I would be quite interested in.
Well, gentlemen, I have far more questions than we have time. So I want to get to another couple of questions here. Christian, if I could go back to you. Swiss Re recently signed on to the Net Zero Insurance Alliance, which commits those who've signed on, excuse me, to making the necessary underwriting and asset allocation decisions to help reach the Paris goal of limiting global warming to well below 2, preferably 1.5 degrees Celsius compared to those pre-industrial levels that we talked about. This is a very ambitious collective commitment to addressing climate change. Now, do you view moving towards net zero underwriting as more difficult than net zero investing?
Yes, significantly. More difficult. On the investment side, you have liquid assets, and you will find over time people who rate them, who can say that's the footprint, this official data, and you will be able to calculate your footprint within seconds. And as you know, we have committed to net zero on the investment side, together with $5.5 trillion of this net zero asset owner alliance. So there's big movement on the shareholder side or bondholder side, which helps this whole movement. And so we have also committed by 2025 to be minus 35%. So you can do it. You move with the whole world towards net zero. The underwriting side is much more difficult because the method, how you calculate, is much harder. The transparency is less so, and then it goes through the value chain. So it goes first to insurance companies. They underwrite thousands of risks, and we have now, since last year, the chief risk officers of the industry have come up with a method. But then these people bundle all these risks and give us a so-called treaty to reinsurance. And that's a big challenge because they don't give us the data at this stage. So we will have to find ways to get the data so that we can rate how good, what's the carbon footprint basically of a reinsurance treaty. So there's lots of hurdles to overcome. None of them are impossible to overcome, but there's just a lot of work being done at this point in time. So it's not solved yet. I think at COP26 we're going to publish certain things, but to me that's maybe two years of work until we have a good method, and hopefully after that the information will flow. And that's where transparency will be very important. The pressure from governments to all companies to be transparent about their carbon footprint, that will be super important for all of this to work.
Thank you, Christian. If we have time, I'd like to return a little bit later to that question of data in disclosure, which you so correctly say is so critical to this. Sven, if I could move to you with a related question. With insurers moving towards net zero underwriting, what's your view on the respective roles of divestment and engagement with emitting sectors? And what I mean there are insurers most effective when pushing those emitting industries to do better, or simply avoiding them altogether?
Well, there's not a black and white answer to this, because obviously there are areas where a divestment strategy makes perfect sense. So the typical examples are development of new sources of fossil fuels, in particular coal and lignite, which are simply technologies which need to be phased out, and new investment in them is probably a stranded asset. So therefore, that is the easy ones. Yeah. In other areas where deep transformation is needed, of course, divesting them is a bit unlogical. It's also not what we want. We will also need cars and chemicals and all the rest of it in the future. So therefore, in this area, a credible engagement strategy is highly helpful. And of course, insurances hold a lot of assets, and therefore you have real power. And the more you join with your voting rights, those people who do activism shareholding or shareholder activism, the more effective that is. Therefore, I can only say I'm in favor of engagement in these areas, but of course, engagement is only credible if there's also the divestment option. So that is clear. And beyond that, there's of course also some ethical questions in there. So when it comes to the underwriting in particular, because, and I wanted to ask after I read the material of your alliance, of course, I welcome very much that you take that step, and but I think it also poses some ethical questions. So when there is scientific evidence that certain areas of investment should simply not be continued, then there is a simple case for divestment. But how do you do this with underwriting? So where very often you have a real risk, and then insurances collectively say we will not insure it anymore, while the same activity is still allowed in law. This seems to me a difficult area, how to choose the areas where you stop underwriting or phase out underwriting and where you don't. So to me, I'm very curious how your alliance wants to solve that problem.
Christian, do you want to come in there?
Yeah, so you're right. These are some of the most difficult questions, and it'd be stupid to say it's easy to answer them. I mean, generally, the approach is for the net zero, we accompany the world. We go together with the world. I think that's a very important philosophy. So we shouldn't run ahead and drop everything, and that's not going to help the world. We want to accompany the world, go together, which means engagement. So that's going to be the predominant thing. But already for 10 years, for example, we're not insuring the tar sands and some other technologies, and we don't do landmines, and I think every company can decide that. We cannot do that in associations, by the way. There's no way for the insurance industry to come together and agree on something like that. That's no way. But as a single company, we're allowed to make choices. And we have made them all along the way on certain particular issues. And coal in particular, for example, in OECD countries, we're going to dephase completely 2030. It gives enough time for those who want. We're not investing in new projects, coal, since 2 years, I think. So we also, it's a process. We make our path. We have to take decisions. Some of them are difficult or emotional. But it's always in the spirit of pushing the boundaries a little bit and helping this overall process of going to net zero. And as you say, if those who don't follow the path, they will not be in our investment portfolio, they will not be in our underwriting portfolio. But I think for the bulk of the industry, it's really important we accompany them. Yeah, the car makers, also the oil and gas industry. There's a lot of technologies. They are part of the solution. Hopefully, they have a lot of engineers, technical knowledge. They're just being pushed, as you know, right now quite significantly, and we will be one of them. We're going to accompany them. So I think that's just a very important. Otherwise, we'll never make it 2050 if you don't work together, more broadly.
I think, Christian, you raise an excellent point, and again, in the Canadian context, we've had those discussions, and I've seen an evolution where policymakers are. And other interest groups are not just pressuring insurers to make these decisions in isolation, where they are bringing the energy sector to the table. And I've seen some excellent discussions around what that transition might look like. And as you suggest, over time, not immediate one-time decisions.
Maybe Don, just to something comes to my mind, because obviously it's all a system. So we have insurance companies, we have these, but you also have the policymakers, and I think it's important we all go together. So, for example, with the new EU taxonomy, there's going to be a risk for reinsurers that. So far in the drafts, it takes a very black and white approach. It could be that suddenly certain things, if there's just one risk in one of these treaties, we can't make transparent, that suddenly it's seen as not sustainable, whereas we are part of the solution. So I think it's really everybody in the system hopefully will look at that there's a path that we all can go together to this net zero.
Sven, I feel like you'd like to come in there. I think you're on mute, Sven. Sven, I think
you're on mute.
You're right. Sorry about this. So, no, the only point I would like to make is, of course, insurance is phasing out underwriting climate-related risks. is of course helpful also to manage your own risk position. On the other hand, of course, we all know with since the IPCC 1.5 report, how big the tipping point problem is, and that we are already not talking 2050, but actually climate science pushes this more or less yearly to earlier dates. So that shows how big risks will remain. And therefore, where I feel sometimes a bit confused about that, on the one hand, the same companies I talk about, whom I talk about climate change, we are basically in a love affair. Yeah, you can see that here as well. There's really not a lot of difference to be felt. On the other hand, when we talk about Solvency II and the like, insurance lobbying tries to push down the capital ratios. So, and then I feel there's a certain schizophrenia. So on the one hand, we agree on the size of the risks. On the other hand, the capital held against these risks, well, there lots of tweaks are to be found in order to reduce the respective figures. And there I'm very concerned what the Commission is at the moment doing, because they are negotiating downwards internally the recommendations by IOPA in order to calculate the respective risks, and they divert from science regularly after certain pressures. So, and there I have a certain feeling of discomfort, only in order not to have a full love affair on all matters. Yeah. So in each relationship, you have also things which you don't like in each other. Yeah. So I wanted to make that point also to make it a bit more lively.
Good. I can answer to that. And I don't know the specific points, because certainly in the insurance industry, that's not the perception that AOPA is easy to deal with. But I think the point where I know there's debates or disagreement is in the Solvency II framework, and that's mathematically steered in terms of risk assessment. We have this yearly risk assessment of all the risk positions you have. And where the insurance industry is against is putting things that are not scientifically proven. So you don't have statistics or anything. The 1 year, if suddenly you had charges specifically to certain assets over this 1 year horizon that are not based on any statistical evidence. What we are saying, and we agree with, certain things will over time disappear. But the way this is calculated is a 1 year time horizon. There's no way that adding big weights to certain industries would not be a steering element. So I think it would be much better to say that we keep the mathematical formula or whatever we calculate there clean, and you have it at a different level. You apply the pressure, the political side of it at a different level. I think that the industry is quite sensitive to bringing political things into sort of polluting the capital model with that. That's on a high level, I think, where you hear that. But you shouldn't misinterpret that as people are not serious about climate change or are not committed to net zero or all of that.
No, look, I think the link here is the following, from my perspective. So if you want to sign an insurance in order to cover yourself also against high-level risks related to climate change, of course, the key value is trust. Will you really get the money when the moment becomes critical, if you have large-scale, say, climate-related disasters? So, and in order to generate that trust, of course, enough capital behind a respective business is critical. So, but we're on the and in order to calculate that for life, we have the insurance, the Solvency II model, and there I agree with you on the principle. It should be really science-based. It should not be ideologically run. So. I was always skeptical that sovereign risks are zero in the OECD world. Because that is against all experience with states. States were very bad in repaying debt in the past. So, and the same applies to some other politically driven changes. So, for instance, strategic participations or certain long-term infrastructure projects. They are suddenly the figures which are used in order to calculate the risk sensitivity are politically changed. And didn't want to criticize IOPA. You are pretty right. They made their job pretty well. But now the Commission has asked IOPA to divert from their own advice, but always downwards. So all the questions Commission asked were only to divert from their own calculations downwards. Of course, this is not invented by Commission. This comes from certain governments, and behind these governments are some companies telling them to make these changes, which they don't have to, but I only want to say this is here in public, this doesn't go unnoticed. And if the principle you developed, science-based, I would underwrite immediately, to use that game of the word.
Thank you both for that exchange. Just to remind the audience to send their questions in. We're running short on time, but I will try and get to one or two of those in a moment. But first, a question for both of you, which is fairly broad, and so should give you some leeway in terms of how you want to respond. And the question is, and Christian, maybe I'll start with you. What do policymakers and the private sector need to do to ensure credibility and consistency in the sustainable finance sector?
Yeah, there's a very broad question. I think the one thing that comes to my mind that is the most obvious one is to push for disclosure. So have one standard and not 5 or 6 standard, and then push for disclosure, because that just helps. If everything is transparent, I think you have a lot of self-regulating forces. But I would add, maybe, if you allow me, to open up a little bit on the role of the governments and insurance industry, and how I think we're going to crack the nut. I think you on one hand see more and more governments who have set the net zero target 2050. So I think it's 60% of the emission volume or so. There's a commitment behind that. But that's just one dimension. The other dimension is the corporate dimension, and maybe share a little bit what I'm seeing there, because I'm highly engaged. So you have about 20% of the Fortune 2000 companies who have also committed to net zero, and they are talking to each other, and what they are discovering, obviously, is to be net zero, everything they produce has to be net zero, but everything that is delivered to them has to be net zero. So they go to thousands of companies that deliver to them and ask them to be net zero. Otherwise, they can't use it. And that will include a lot of these hard-to-abate industries, because typically there's a lower profit margin in those. They're early in the value chain, so aluminum, steel, cement, etc. See, what is interesting is it might only be 20% of the Fortune 2000 companies, but they have a huge scale effect. So there's a network effect. They go through the network, they push others to be net zero. So you have a bit of a domino effect. So you have the countries on one hand, and then the corporations who are across countries on the other hand. And there are a network that is propagating this. Plus, I think the interesting effect, if you calculate, if you produce green steel and green aluminum and all of that, which is possible, it starts to be possible, it's more expensive. It's impossible for these companies to do it with the current profit margins. But if you distribute the costs across the value chain and look at the end product, it's possible to create green end product for 2 to 4% high costs. So a house would be $5,000 more expensive, a car $500 more expensive, a pair of jeans $1 more expensive, an iPhone $3 more expensive. So if you have these companies at the end, close to the consumer, forcing this net zero and willing to pay a higher price for green steel, for green aluminum, it's actually very feasible. That's what making me and people are realizing that. So there's a big, I think, awakening in the corporate world right now. So I think these two effects together, I think will probably crack the nut, make me more optimistic. Yeah? And we come at it from two different sides.
Thank you, Christian. Sven?
No, I fully agree. I can only say, as a policymaker, our obligation is, of course, to change the economics behind this, because the logic to say you have to have a higher price in order to do a green business model is, of course, only showing that our prices are not saying the environmental truth. And our job as policymaker is to put a price on CO2 and therefore make it more profitable to do the green way. Because obviously it's great if companies make net zero commitments, and by that way pushing against the economic incentive. But our objective as policymakers has to be to align the economic incentives with ecological reality, which is also economic reality. And that is where we really have to get together. Perhaps you have seen it. We had a ridiculous debate in the last 2 weeks about a 16-cent price increase on fuel in Germany, which the Greens announced for the next year. So 16 cents, yeah? So it's really, it is not that much, yeah? So in comparison to where we have to get to make CO2 pricing really work. And we all know this, but there's an insane public debate. And these sort of debates we have to win. We also have to stand these debates and not give in to everyone who criticizes this. So I fully agree. On the taxonomy, I only wanted, because you made an interesting remark before, Christian, about this. Well, in a certain way, a taxonomy is about black and white. So saying what is green and what is not green. Otherwise, it's not a taxonomy. But I think there's a widespread public misunderstanding about the meaning of the taxonomy. The taxonomy is not about to forbid anything. That would make no sense. It is only saying this is green and that's not green. That doesn't mean that immediately we can stop everything which is not compliant. But what I see at the moment is tremendous pressure put on the European Commission to declare things as green, which are not green at all. So, and that would destroy the credibility of the taxonomy. So I think we have to be much clearer that this is not about forbidding what is not green, what is not declared green, but that the definition of green has to be credible. Otherwise, the whole taxonomy will lose its economic force. And our objective to use these definitions to make Europe the lead market for sustainable investment will fail, because if the definitions are not convincing, if they are not clear enough, nobody will believe in our labels. And beyond that, I fully agree on your requirements for disclosure. We really have to be tough, because only if the data is there, the financial market can do its job. So this is something we have to deliver together. So the whole corporate world has to deliver trustworthy CSR-related data.
Thank you, Sven, for that, and Christian. I'm going to take one audience question here, and I was just watching it go up in the number of votes, so it's the most popular question here. Christian, it's directed at you, but Sven, I certainly invite your perspective here as well. And the question is, do you see differences in perceptions about the need to act on climate change across the world? And do they create challenges or opportunities for European insurers?
Definitely. I mean, you see very big differences. I think that there's now more unity, but typically you had, I think, America with part of the CEOs very skeptical or worried, even if they themselves saw this as a key issue. It was politicized, and they felt that if they are too vocal, the shareholders might not support them. So there was a bit this shareholder fear, and that's, I think, rooted in the law. The law is different in the US than in big parts of Europe. You know, for example, in Switzerland, the board of directors is responsible to the company, not to the shareholder, to the company. It's a broader concept, whereas in America, it's clearly to the shareholders. So the board has to respond to the shareholders, and that leads to different behaviors and so on. So I think in the US, there's much more caution, and there was much more caution for a long time to be too public about things. This is changing now because, people are seeing this is not a political issue, climate change. It's just a disaster happening in front of our eyes. But clearly, I think the European companies have been earlier there, earlier in, etc. And in Asia, for a long time, this was not a topic. I mean, they had totally different problems. They had high growth. They needed to penetrate. The insurance penetration had to be increased, etc. But here, I see big increases also in interest. So we are talking to some Chinese insurance companies who want to hear about ESG ESG. They want to hear about that. And they are not in disagreement at all. They take a very scientific approach, actually. So to a certain extent, I'm more encouraged by what I see in China than what I see in the US sometimes, because it's not a political issue. It's clear. It's something they're just late in the, early in the development, and they have less time to go through this whole transition, but I think they will execute on that. And then obviously you still have a lot of countries the poorer countries where this is not a topic at all. So yes, you see differences, but we try to move together as much as possible. So we try to go across, we try to encourage others, to talk to others, and generally the momentum is also increasing there because a lot of these governments are switching to this net zero. Can it be an advantage? I think for Europe, generally, there's an opportunity here. I mean, if I see these CEOs who have committed to net zero and the investment needs, if you want to do green steel, green aluminum, and some of it is in Sweden, for example, some of it is in Germany, there's different countries, there's going to be massive investment in new technologies. And it would be a pity if Europe doesn't use the advantage they have. Everything will have to change. I mean, the transition will be huge. And once you're in it, in the beginning, you're afraid, what Sven said before, because you see the change, my God, it's going to be difficult. But if you're a bit further down the line, you see the opportunity, because everything will have to switch. And you know that for years now, lots of companies were not investing, they were paying back shareholders, they had no ideas what to do. Well, now there's something to do here. It's massive. I think the demand for green steel, green aluminum, green cement will be much bigger than the supply, because it takes years to build up these factories. So in my view, there's clear opportunity here, not necessarily just for insurers, but for Europe as a region.
Thank you, Christian. Gentlemen, we have about 3 minutes left. So what I propose is to give each of you an opportunity. We've barely scratched the surface on this topic. I suspect this discussion could go on for hours. But to be completely unfair, we have 3 minutes to wrap up. So perhaps, Sven, I'll start with you, and maybe just a few closing thoughts before we close the session.
No, I was inspired by the last part of your question, and also the response by Christian. I can only say, it seems to me reality will also globalize global reactions. So we saw it in Australia, a country which was shaped by climate denialism. And then there were these ravaging and shocking fires, and things have at least changed a bit. And we will see more of this. And therefore, I think this problem will be reduced. And now we have, of course, a big opportunity, because in the US, there's now leadership. And if I see the investment policies, also the green investment policies of the Biden administration, I think Europe is also challenged to keep the momentum. And therefore, a transatlantic alliance for the greening is the basis in order to globalize. And for this, I think there's only one truth. In order to win global majorities, and we also will have to share technology and probably also some financial means. So this will not only be nice green investment in Europe, in America, it is also about winning over transition and developing countries. And this will also cost some resources.
Thank you, Sven. Christian, last word to you.
Yeah, first of all, thank you for inviting me here. And it was a great pleasure to meet Sven. There should probably be more discussions like that amongst us. But I'm very optimistic, and that's after being quite pessimistic for a long time. Talking about this for 15 years, not seeing any momentum. And now finally, I see a lot of energy being freed up. Yeah, there's the US, Europe is charging ahead. I think the population now has understood or seen it in most countries in the world. You see it now. You can see it, you can feel it. And so all in all, I just think a window of opportunity has opened. There's finally enough momentum. And I would say, yeah, full steam ahead. We now need to gain as many alliances, many countries, as many corporations as possible. Because the transition will be huge. It's a huge challenge, but it is feasible. So I'm certainly fully committed to go there.
Gentlemen, thank you both so very much for this session. One of the shortcomings of doing these things virtually is you can't hear the applause that I know would be coming from the audience. It was a very engaging. So on behalf of the audience, I will provide a small applause for you. Thank you again. To the audience, that's it for today's session. I want to thank again Mazars for sponsoring Resilience Week. Insurance Europe's Resilience Week continues tomorrow with a discussion on what the COVID-19 pandemic has taught us about how we manage future systemic events, be they pandemics, cyber attacks, or climate action failures. Gentlemen, again, thank you and goodbye. Bye-bye.
Thank you very much.